The Crypto Markets Update is presented by Grayscale, the world's largest digital currency asset manager.
All right, joining us now to discuss the crypto markets is Messari CEO Ryan Selkis. Welcome to the show, Ryan. So taking a look at Bitcoin, we saw a huge fall the other day. Now it seems to be stabilizing. Futures are up in traditional U.S. equities. What's your interpretation, analysis of what's happening?
Well, I do agree that some of the fears are more macro-based, and crypto broadly is still a very risk-on asset and will be for the foreseeable future. It's volatile. It's something that has seen quite a bit of speculation over the course of the last 18 months. We're deep into a bull market right now. I don't think we're at the end of that bull market, hopefully, but the key, I think, internationally, not just for the stock markets, but also for the crypto markets, is whether the situation in China is contained or whether it truly could spark some contagion. And that's above my pay grade. But right now, I can tell you it hasn't really fazed the folks that are here live with us at Mainnet.
Ryan, you mentioned China, and I assume you're talking about Evergrande, right? Not China's crypto crackdown.
Right.
So that seems to me like when we talk about contagion, that's generally talked about in terms of the stock market, right? And how that's been sort of, the fear that's where contagion would hit. So why would that affect the crypto market necessarily? Because, as we were discussing earlier, what is this correlation here between, something that's happening in China that may or may not be affecting, the stock market, and why would that spread to crypto markets necessarily?
Well, I mean, in the U.S., the property bubble and boom and bust in 2008 was largely the result of a property bubble as well. And that had trickle knock-on effects into the stock market because there was so much global exposure to subprime mortgages. So everything is connected at the end of the day. And whenever you just have an asset manager or a company that is at the scale as Evergrande, it could cause some second-order effects that are unknown, and I think that fear is trickling through the broader markets right now. Crypto is not completely divorced from the reality of the rest of the macro markets today.
Yeah, that's what I was just sort of going to ask you. I mean, do you think in some ways this undercuts a little bit this myth of crypto as being a little bit unique and independent from the more traditional markets?
Well, I don't think in any short period of time you can draw a conclusion whether or not Bitcoin and crypto assets are a good hedge. If you look over any longer period of time, medium term, long term, crypto is an asset class, and Bitcoin in particular individually is an uncorrelated asset that's performed exceptionally well. So I think long term you're looking at a hedge or a portfolio diversifier, but in a liquidity crunch and a flight to safety where there's a lot of fear in the market, you're going to see everything correlate to one, essentially. And that's what we've seen last year in March during the COVID, beginning of the COVID crisis, when the markets really woke up to the threat and we saw the first lockdowns. I think you've seen that kind of periodically over the course of the last several years. Whenever there's been a major sell-off, either due to fears that the Fed might be tapering asset purchases, COVID, any significantly bad news, and I put Evergrande in this camp, correlations tend to go to one, and unfortunately that's in the wrong direction this week. But the much bigger question is, how large is this crisis going to be, and again, will there be second-order effects, and will this go far beyond Evergrande, or will it be contained?
Ryan, I see that you are on Mainnet. I had the pleasure of attending the conference yesterday. It's happening Monday, Tuesday, and Wednesday of this week at the Marriott Marquis in New York. It's been a great conference, having a lot of great conversations. There is, as I've been having these conversations with folks in the crypto industry, one topic that continues to come up is regulation in the crypto industry, especially in the United States. A lot of people have been talking about the SEC going after folks for lending products, yield products. We see that with Coinbase having to deal with that, and now they've decided not to launch their lending product. With stable coins, there's a potential investigation into whether or not they impact the financial stability of the broader financial markets. I wonder, is that spooking the markets?
Honestly, it's tough to tell on a day-to-day basis where these swings come from. With the entire market selling off yesterday, it's hard to draw a conclusion that this looming regulatory threat or more aggressive language from the SEC is what caused the spook yesterday. I think that's more or less been priced in over the course of the last couple of months following the infrastructure bill and its passage through the Senate. So I think that's more of a long-term, medium-term trend that the market is keeping a close eye on. I don't think that has anything to do with this week's sell-off per se. But I will say it is thematically one of the things that everybody is talking about. How can we get better clarity from the regulators in the U.S. and how can we actually get clarity that doesn't start and end with threats and then enforcement actions? Because ultimately what we want to be able to do is preserve what is the highest growth sector of American tech right now, and a $2 trillion asset class has been bootstrapped from nothing in just about a decade. So I think the folks that are here on site are not speculators and day traders. They tend to be some of the folks that are building in the trenches, whether they're early stage investors, whether they're developers, other entrepreneurs and infrastructure companies. And it's 2,000 of the top folks in the world that are really trying to advance crypto and believe in crypto for the long term and want to see it succeed and fit within a smart regulatory framework. What's missing today is the smart regulatory framework. So I think that's what we're going to have to be very assertive about as an industry, and I've certainly been outspoken about that. But I think we'll make slow and steady progress on the tech side. Hopefully that translates into some results with some of the policymakers in DC, in Europe, and everywhere globally.
Ryan, what do you think? I know this is a complicated question, but what would you consider a smart way to regulate DeFi? Because probably some regulation is coming, right? But what do you think would be an appropriate way to go about it?
Well, I think clarity on tax reporting requirements would be a good start. I think regulating the centralized exchanges who are already regulated, right, and making sure that they have clear guidance on what tax reporting they should be doing on behalf of their customers. Embracing something like a safe harbor that Commissioner Peirce at the SEC has proposed and is very thoughtful about. It replicates much of what you'd expect from a public company filing in the U.S., but acknowledging the unique properties of some of these assets. So those are just kind of three areas of low-hanging fruit that I think would go a long way. And the reality is the regulatory state in the U.S. Has a hammer and everything in crypto looks like a nail right now, where I think they could ultimately be much more effective is if they were able to take their foot off the gas a little bit and recognize that any centralized entity that can be regulated, that is already subject to certain regulations, would be a good starting point for this discussion. But not to throw the baby out with the bathwater and come out like the current chair, Gary Gensler, has done and say that almost all of these projects are securities, because it's just a non-starter. It's going to push innovation offseas or offshore and overseas, and ultimately it's really going to constrict the economic growth of the U.S. if that becomes the law of the land.
Mm-hmm. Ryan, just one final question. At the conference yesterday, there was a bit of news that someone actually from the SEC came to subpoena someone. And I know you may be uncomfortable with this question, but I have to ask the way you answer it, please. As a journalist, I have to ask it, but you can answer the way you want. But from your tweet, we saw that if you're wondering, this is from your tweet, if you're wondering when I actually decided to run for Senate, it was when these people came to my event, didn't buy a ticket, and served one of the speakers a subpoena. Enough talk, more war on our out of control regulatory state. I think your tweet speaks for itself, but do we know who it was who was served a subpoena? Can you confirm or deny? We're hearing word that it was Do Kwon, a co-founder of Luna.
I can't confirm that. I'm not sure who it is. And frankly, because we don't know who it was, we're not actually sure that we can confirm that story altogether. But there were enough whispers about it that I did want to address it publicly, and really kind of turn this into a moment to catalyze folks in the industry to wake up to the fact that this is not acceptable behavior from elected representatives and regulators that ultimately work for those elected representatives to indiscriminately crack down on an entire industry, blow off invitations to attend the leading U.S. industry conference this year, within this space, and ultimately make a good faith effort to engage and try to educate themselves on what's actually going on. So I think, the tweet does speak for itself, and I know it's gotten a good bit of pickup, and the tone is aggressive or assertive, but it, I think, underpins the sentiment that most in the industry feel right now, even if they don't say it out loud.